If you lived in the US on a work visa, such as an H-1B or a TN, and you aren't a US citizen or green card holder, and you're moving back to Canada, make sure you watch this video. I'm going to be going over a lot of really important tax, financial, and investing information as it relates to moving to Canada. Whether you're moving back to Canada after living in the US for a few years, or if you're moving to Canada for the first time after living in the US on a visa. Hi, I'm Sonia. I'm a CPA licensed in both Canada and the US. I'm a cross-border tax consultant and the co-author of my new book, Your Move to Canada. This is some essential reading when it comes to moving to Canada from the US, whether you live there on a visa or were a US citizen or green card holder. We go over almost everything you need to know from a tax, investing, financial, and estate planning perspective. So let's get started. The first and most important concept as it relates to moving to Canada or moving back to Canada is your Canadian tax residency. I'm going to link a video below that I made all about establishing Canadian tax residency. The important thing to consider is from a high level, if you're moving here on a one-way move, you're establishing residential ties here, such as having a home in Canada, and your intention is to move here for the foreseeable future, you'll generally be a Canadian tax resident as of the day you physically arrive. The important thing you need to know is that Canadian tax residency is completely separate from your immigration status, such as a permanent residency or a Canadian work visa. So you could move here on a temporary visa, but you could still become a Canadian tax resident if you establish residential ties. Once you become a tax resident of Canada, you're subject to all our Canadian tax rules and subject to tax on our worldwide income. So in this video, I'm going to be going over quite a few things. I'll be going over your TFSA, RRSP, your non-registered or non-qualified investments, and also your US retirement accounts such as 401ks, IRAs, and Roths. Now let's talk about US filings when it comes to moving from the US to Canada after living in the US on a visa. So you were considered a US person and subject to tax on worldwide income because you met something called the substantial presence test. The substantial presence test means that you exceeded 183 days in the US using a 3-year look-back period, where you count 100% of the days in the current year, a third of the days in the year before that, and a sixth of the days in the year prior to that. However, once you no longer meet the substantial presence test, you're considered a non-resident alien for US tax purposes. In the year of your move, you might meet the substantial presence test, but you also would establish Canadian tax residency. For that case, you may file what's called a dual status tax return. That acknowledges that you're a US resident for part of the year because you met the substantial presence test, but you also established residency elsewhere. With the dual status tax return, you essentially have a two-part return. You have the first part, which is your resident period return, where you report your worldwide income, and then you have your non-resident return, where you only report US sourced income during the non-resident period. And then in future years where you're a non-resident alien for the entire year after you're living in Canada, then you might not have any US tax filing requirements, but make sure you check with an accountant. It will ultimately depend on your sources of income. For example, if you have employment income that you receive while living in Canada that was technically earned in the US, such as equity compensation or a bonus, that might continue to be taxable in the US. I have an entire chapter in my book on trailing employment income, so make sure you check that out. A common question that I see are people who are married to US citizens or green card holders, and then they're moving to Canada together. When you were living in the US, you would have filed jointly, but what happens after you move to Canada? The spouse who is a US citizen or green card holder still has US filing obligations because of their citizenship or green card status, but the other spouse who doesn't have citizenship or a US green card may not have any US filing requirements. Oftentimes, if that's the situation, then after you're living in Canada, a US citizen or green card holder would file under married filing separate status, and that acknowledges the fact that they're married, but they are filing separately from their spouse, and then the spouse who doesn't have any US status may not have to file at all. Keep in mind, there may be an election that's available to allow married couples in this situation to file jointly, but oftentimes people don't do this. What that effectively does is it pulls the non-US citizen or non-US green card holder into the US tax net, subject to all the US tax rules that people work really hard to actually get out of. Things like your TFSAs, Canadian mutual funds or ETFs, having a Canadian business, all of those complexities would come into play if you file jointly with a US citizen or US green card holder spouse. So make sure you talk to an accountant if this election even makes sense. Oftentimes though, people will just file separately from their spouse if one is a US citizen or green card holder and the other is not. So first, let's start with the TFSA. The TFSA is a tax-free savings account or a tax-free investing account in Canada. If you're moving back to Canada from the US, you may know that the US has some tax issues when it comes to the TFSA. I'll link my video below that I made on that topic. Otherwise, if you were in the US on a visa and then you're coming back to Canada, once you are no longer a US resident for tax purposes, then you no longer have to worry about the US issues associated with the TFSA. Once you become a Canadian tax resident, you're able to contribute to the TFSA again, but be be very careful, do not make any TFSA contributions while you are a non-resident. You'll get the full amount of TFSA room that is earned for a given year in the year you move to Canada. Even if it's in the latter half of the year, the amount you get is not prorated. So for 2026, that figure is $7,000. Now, if you're moving back to Canada, you may already have a TFSA open, or you may have shut down your TFSA before you moved out of Canada to go to the US. In that case, your TFSA contribution room would equal whatever remaining room you had before you made the withdrawal, plus the amount that you withdrew, as that amount gets added back to your contribution room as of January 1st the following year. Plus you'll get the 2026 dollar amount for the TFSA, or whatever year you end up moving to Canada, you'll get that dollar amount back. You might go on the CRA website to try to figure out what your TFSA room is. Keep in mind, it's not always very accurate. It may be out of date, especially for people who are moving in and out of the country with residency changes. In fact, if you're currently a non-resident, then if you go on the CRA website, they might not even show you anything regarding your TFSA room. It might just have a message saying non-residents cannot contribute to the TFSA. Next, let's talk about the RRSP. So if you're moving to Canada for the first time, the RRSP is like our equivalent of a traditional IRA or a 401k. But the thing with the RRSP is you can't actually make contributions unless you have RRSP contribution room. Your RRSP contribution room is based on your prior year's Canadian earned income. So if it's your first time ever living and working in Canada, in the year that you move, you won't have any prior year's Canadian earned income. So you may have to wait to contribute to the RRSP until the year after you move to Canada. But if you're moving back to Canada after living in the US on a visa, you may have some RRSP room remaining from when you were previously in Canada. So in that case, you're able to contribute to the RRSP again once you start working in Canada, and that will provide a tax deduction against your income reported in Canada. Now let's talk about your pre-tax US retirement accounts, such as your 401k or your traditional IRA. Once you move back to Canada, these will continue to be tax deferred from both a Canadian and US perspective. What that means is any income within those accounts will be tax-free. Once you start drawing from those accounts as a Canadian resident, you're subject to tax in Canada on the value of the withdrawal converted to Canadian dollars, and that's subject to tax at marginal rates in Canada. If you're a non-resident alien of the US when you make those withdrawals, there will be a 15% withholding tax. And that withholding tax is under the Canada-US tax treaty on periodic payments from those US retirement accounts. But keep in mind, I've come across a lot of US financial institutions who are not comfortable allowing their clients to benefit from this 15% rate, and they demand to withhold 30% instead. However, the issue is the CRA will only allow you to take a foreign tax credit for 15% because that's the rate under the treaty. So in that situation, you may have to file a US tax return to get the excess withholdings back. Alternatively, there are specific cross-border wealth management firms out there who have a lot of experience dealing with non-resident aliens in the US who have US retirement accounts, and they will apply that 15% rate without any issue. Feel free to reach out to me to my email below if you want more information about this. And a common issue, however, is regulatory. And what that means is that once you are a Canadian resident and you have a 401k or a traditional IRA, the US financial institution is likely not going to be licensed to deal with Canadian tax residents. Is what they may tell you is they may have to freeze the account, which means that you are not able to make any changes to your portfolio or make any trades, and the account is essentially going to be set to sell only. So you'll be able to make withdrawals from the account and you'll be able to sell assets within the 401k or IRA, but you're not able to make any changes or get any ongoing financial guidance from that institution. However, there are dual licensed advisors in Canada, which are licensed in both US and Canada, and they can hold traditional IRAs. Again, feel free to reach out to me if you want more details about this. Now, hearing about all of these regulatory and tax issues, you might be one of the many who think, I'm just going to transfer my US retirement account to my RRSP. But please be very, very careful before you do that. I have an entire chapter on my book walking you step by step with what's called the 60J transfer, which is transferring your US retirement account to an RRSP, and why it is oftentimes a very bad idea. The reason being is that in order to make a transfer from your US retirement account to your RRSP, it has to be done while you're a Canadian resident, and the US doesn't see anything special about you doing this transfer. It is simply considered liquidating your US retirement account. And if you're a non-resident alien, that is subject to a 30% withholding tax. And if you're under the age of 59 and a half, there's an additional 10% penalty. That's up to 40% US tax off the bat on the liquidation of your US retirement account to transfer to an RRSP. Now, you may be able to recover some of that US tax, but you can only recover that US tax to the extent that your Canadian tax liability on all your other sources of income exceeds that US tax bill. So I know that's a little bit confusing, but let's say, for example, you want to do this transfer from your US retirement account to your RRSP, RRSP, and it triggers a tax bill of $50,000 US. Assuming the exchange rate, let's say that converts to 65,000 Canadian dollars. In order to make this transfer tax neutral, your tax liability in Canada on all your other sources of income, such as your other employment income once you start working in Canada, would have to exceed $65,000 to make this a tax neutral transfer. So unless you're a very high income earner, or unless your US retirement account is quite small, oftentimes this 60J transfer is actually a very bad idea and results in double taxation. But again, there are Canadian financial institutions who can hold traditional IRAs, so you don't have to accelerate this taxation. So be very careful if you go to a Canadian financial institution and they tell you to do this 60J transfer and move your US retirement account to an RRSP. Oftentimes, people working at Canadian banks are not familiar with US tax rules. They're not cross-border experts, and they may not know the punitive US tax rules that could arise as a result of moving your US retirement account to an RRSP. Next, let's talk about Roth IRAs. So the Roth IRA is actually excellent for cross-border planning because it can be completely tax-free in Canada. All you have to do is make sure that once you move to Canada and you become a Canadian tax resident, you do not make any more contributions to that Roth IRA and do not make any Roth conversions. You have to make an election with the Canadian government alongside your tax return for the year you establish tax residency, just providing details about your Roth IRA, and that will make it tax-free in Canada. And then again, the US will acknowledge the tax-free status of the Roth IRA. Withdrawals from your Roth IRA will be tax-free in the US, provided that you're at least 59.5 when you make the withdrawal and you held the IRA for at least 5 years. Again, you may run into the same regulatory issues with the financial institution not being able to manage the account, but again, there are Canadian financial institutions that are dual licensed and that can hold Roth IRAs for Canadian residents. So if you qualify to max out your Roth IRA before you move to Canada, make sure you do so because it'll be essentially like an extra TFSA once you come to Canada. All right, I'm leaving the best for last. This is one of the most major tax planning opportunities for US visa holders who are moving to Canada if you have investments in a taxable or non-qualified investment account. When I first heard about this loophole as a tax practitioner years ago, I almost couldn't believe it, but it's true. Once you move to Canada with investments in a non-qualified investment account or a taxable investment account, your cost basis of those stocks is the fair market value at the time you establish tax residency. So your future capital gain in Canada on those investments is going to be the difference between what you sell it for and what it was worth when you arrived in Canada. So any gains that accrued before you moved to Canada will not be taxable in Canada. But here's the good part. If you sell those stocks as a non-resident alien of the US also has no right to tax you on capital gains of the sale of those stocks or mutual funds. So what that essentially means is that if you sell those stocks as a non-resident alien of the US, so after you move out of the US and after you severed your US tax residency, any gains that accrued on those stocks during your time living in the US will not be taxed, neither by the CRA or by the IRS. So make sure if you have stocks that have gains in a non-qualified or taxable investment account, do not sell those until after you cease US residency and move to Canada. So again, timing really matters with this stuff. So I hope that was helpful. If you lived in the US on a visa and are moving to Canada, there's lots to keep in mind, lots of tax planning opportunities. Make sure you pick up a copy of my book, Your Move to Canada. I go over all of the things that I discussed in this video in this book, and there's so much more information here as well. We'll talk about your entitlement to US Social Security if you lived in the US, details about real estate, and so much more. If you pick up a physical copy of my book, feel free to email me to my email below. I'm happy to have a quick chat with you about your tax situation. While I don't prepare tax returns, after chatting, I may be able to make a referral to some firms who do. Thanks for watching and have a wonderful day. Bye.